Hello, everyone. This is Yoko. In this channel, I will share information in English that I have gathered myself because events happening in China are not widely reported in other countries. I gather information from various media sources, so I would appreciate your comments on the content of the videos. English is not my native language, so I use an AI speaker to read in English. If you enjoy the content, please subscribe to the channel and show your support. Now, let me introduce you to the wild world of China. Today, I would like to discuss an unknown issue in the Chinese economy. On October 31st, short-term interest rates surged, reaching 50% in China. In response, Chinese authorities announced an unprecedented investigation into the reasons behind this event. This surge refers to the overnight repo interest rates between banks. While the daily interest rate is stated to be 50%, it's not on a daily basis but is an annual rate equivalent to 50%. The rapid increase in short-term interest rates is the highest in China's financial market in a decade since a temporary rise of 14.9% in 2013. This recent increase is more than 3 times that, causing significant shock. The 2013 surge prompted Chinese authorities to introduce various mechanisms to prevent such situations, including the Medium-Term Lending Facility, MLF. The MLF, commonly known as Malofin in China, is a mechanism designed to supply cash in case of potential cash shortages. Interestingly, the term Malofin is derived from Chinese words associated with morning, tingling sensations, and the spiciness of chili peppers, symbolizing a seasoning perspective in culinary terms. The purpose of implementing these mechanisms is to prevent a sharp rise in interest rates due to a shortage of cash. Additionally, the Standing Lending Facility, SLF, known as Swanlaufen, has been expanded to provide support not only to major financial institutions but also to smaller ones. Despite these measures, the unexpected surge in short-term interest rates in October surprised authorities, indicating that the existing systems were not sufficient to prevent it. This event is drawing attention in China's economic and financial circles as it occurred despite the preventive measures implemented by authorities after the sharp rise in short-term interest rates in 2013. The discussion of structural issues in the Chinese economy is rarely covered in Japan. Therefore, this time, I'd like to focus on that aspect. First, let's delve into why there was a sudden surge in interest rates and a cash shortage in October. There are 2 significant reasons for this event at the end of October. One is the current environmental factors. China's government is facing a cash shortage situation, leading to a massive issuance of government bonds amounting to approximately 20 trillion yen. What makes China unique is the substantial debt of local governments in each province, which constitutes a significant portion compared to the central government's bonds. While the central government's bonds may not seem significant compared to Japan, the individual debts of each province are comparable in scale to medium-sized countries in Southeast Asia, making for a considerable total. To regulate local government debt, special entities known as financing platforms were created. These platforms were established to circumvent regulations and, while legally distinct from government debt, were essentially guaranteed by the government. To repay the debts of these special entities, local governments issued bonds, resulting in a massive flow of funds to local governments. This, in turn, led to the absorption of cash, causing a decrease in liquidity, a significant reason for the cash shortage. The other reason is the underdevelopment of China's bond market, a crucial point related to the structure of China's financial system. China's bond market is not as mature as one might think. For example, when banks undertake loans, they may hold the assets in the form of the loan. However, if faced with a cash shortage, they might want to sell those loans to raise cash. Yet, if the market for selling loans is underdeveloped, this becomes challenging. In China, banks often hold on to bonds until maturity, lacking the flexibility for easy buying and selling. To address this, China needs a well-developed bond market in which financial institutions can participate, facilitating the necessary flexible buying and selling to improve liquidity. However, there are concerns that the Communist Party of China may be cautious about moving in this direction, citing fears of losing control. The party's stance on the development and nurturing of the bond market has been somewhat negative, at least according to previous information. The current direction remains uncertain. When discussing the development of the bond market, it involves more than just creating platforms for buying and selling. For example, in bond transactions, there is a difference in risk between those with almost no possibility of default, such as international bonds, and those with uncertain future prospects and the potential for deteriorating finances, such as corporate bonds. Dealing with these risks requires credit ratings, and if the buyer of the bonds wants to limit losses in the event of default, they may use financial products like credit default swaps. An important point here is that the expertise in derivatives and credit ratings is fundamentally lacking in China. Therefore, if these mechanisms are introduced, there is a high possibility of involving Western companies in the sale of derivatives and credit ratings. However, doing so would mean allowing foreign control over China's financial infrastructure. There are bitter sentiments among people regarding rating agencies. Nevertheless, businesses often operate based on credit ratings, and the use of these agencies is unavoidable. As a result, funds tend to flow automatically to these rating agencies. This dynamic is part of the financial infrastructure, and the United States has a significant influence on it. Therefore, developing the bond market in China could potentially lead to a situation where a massive amount of funds automatically flows from China to the United States. This may be a cause for caution on the part of the Communist Party, as it could imply a loss of control over their financial infrastructure. This is one of the reasons why the mechanism to convert Chinese bonds into cash is underdeveloped. While China's economy has experienced significant growth, its bond market has not matured as much as its scale suggests. This underdevelopment, particularly when compared to the stock market, creates challenges in moving substantial amounts of funds through bonds. Those familiar with these issues express skepticism about the internationalization of the renminbi, RMB, stating that the likelihood of this happening is low. The reason is that dealing with underdeveloped bond markets can make it difficult to accept bonds in RMB and convert them into cash before maturity. Finding parties willing to undertake individual resale contracts might be challenging, potentially causing a significant slowdown in transactions. In summary, China is facing structural issues. Government bond issuance absorbs funds from the market primarily due to two key factors: the massive debt of local governments and the lack of infrastructure in China's financial transactions. To address this, China introduced mechanisms like the Medium-Term Lending Facility, MLF, about 10 years ago with the aim of supplying liquidity. However, even with these measures, concerns about rising interest rates persist. The People's Bank of China has used the MLF to supply liquidity of approximately 30 trillion yen in Japanese yen, but concerns about rising interest rates remain. While the Communist Party has actively intervened with its unique approach, it may have eased some concerns, but broader issues related to local government debt and underdeveloped financial transaction infrastructure persist. That concludes our discussion for this time. Until next time.